welcome to another episode of Focus On. And today we are focusing on the Djibouti Forum at 2025. Up next, we look at the financial markets and economic resilience and their role in unlocking regional and global growth.
So what we're doing is, very clearly, the fiscal space for a lot of African countries are constrained. And hence, their ability to finance primarily through the public sector, their development priorities is challenged. So we advocate public-private partnerships, but there are different forms of public-private partnerships. But that's what we're advocating with governments. We help them build, the capacity to actually structure, public-private partnerships. We help them reform the legal and institutional environment and regulatory environment, because these are long-term contracts, and you have to have, the right enabling environments in place to really attract private sector. We also, provide the ability to do project development, because we've got to create bankable projects, whether they're public-private partnerships or concessions, this has to be created. So there are different ways in which we support both government and private sector come up to the ultimate arrangement. So for example, Africa 50, which is a sister institution of AFDB, was created to do infrastructure project development. And with them, recently, we've come up with a project development and project preparation platform, a $500 million platform, which is administered by Africa 50, but the idea is to create resources for local and regional developers to develop infrastructure projects, including PPPs. And then lastly, we as the AFDB also finance these projects, and we can apply risk mitigation instruments, we can apply credit enhancement instruments, we can actually lead financings as well. But we bring all of this together to really continue to expedite the infrastructure development priorities of African countries.
Looking ahead, which infrastructure sub-sectors do you see as most catalytic for accelerating Africa's global trade positioning?
The interesting thing is that it's really an integration of infrastructure that creates the connectivity, right? Yes. If you don't have energy at affordable prices and reliable, your factors of production are going to increase. So energy is important. If you don't have the transport logistics systems, which is ports, railways, roads, etc., then how are you going to transport your goods cost efficiently? Then if you don't have the right digital infrastructure, you're not able to leverage really the productivity gains and the innovations that we're seeing in various subsectors. Then we tend to have agrarian economies. So if you don't have the agricultural infrastructure, the silos, the storage, cold storage, because 40% post-harvest losses, if you can actually reduce that, then all of a sudden productivity in agriculture production actually comes in. So I'll say it's a combination. It's really an ecosystem of infrastructure that's necessary.
Risk, we can never run away from risk. The higher the risk, maybe the higher the returns, but you never know. So how are you working with maybe multilaterals and also risk mitigation instruments to de-risk infrastructure investment in markets where we are seeing sovereign risk remaining, a major barrier to even private investors?
So we at the AFDB are, globally a AAA rated institution, a AAA rated financial institution. And so we have designed some risk mitigation products, such as what we call the partial risk guarantee. So for example, in the Lake Turkana, wind IPP project in your home country of Kenya, we provided this PRG. And what does it do? It actually counter-guarantees government's obligations on the power purchase agreements. So it gives investors and lenders confidence, that we stand behind, the government's obligations. If the governments do not honor their obligations, we will step in. So that gives really the market confidence. So that's an example of risk mitigation. And, ourselves and other multilateral development banks have developed these instruments. We can actually, do it on a core basis, or we can really divide. We tend to work on a lot of projects together, so we might provide a partial risk guarantee on one project, and they would on others. So that's risk mitigation. But when you look also, 70% on average of the capital costs of infrastructure projects will be debt financed. Okay, 30% equity. So for the debt financing as well, we provide credit enhancements. And this is where we come in and provide what we call a partial credit guarantee, which is essentially a first loss, should there be losses, in terms of honoring debt obligations. So we credit enhance, and it's also another form of risk mitigation. So we credit enhance, but I think the important thing is that a lot of lenders feel that we would be at the table should there be any issues with government to actually negotiate and structure something that would be acceptable to the lenders. So there's the financial instrument, but then there's also the implicit trust in us as a multilateral development bank, Africa's premier multilateral development bank, that we would always be at the table. Now, there's another form of risk mitigation that's pertinent to the Djibouti Forum, which is the African sovereign wealth funds that we're beginning to see, the strategic investment funds. These are quasi-government, quasi-commercial institutions that also invest alongside the investors. That is one of the most powerful forms of risk mitigation because it means government has skin in the game, and should there be challenges in the future, you're assured that at least there will be a listening ear, or there will be really a compromise, platform to really achieve solutions. So we have to think about risk mitigation and credit enhancements, in multiple different ways. And the last point I would make is we are also doing a lot more credit enhancements to raise local currency money. African institutional investors, pension funds, life insurance companies, even the sovereign wealth funds, have significant savings pools in local currency. So what we're trying to do is create institutions. For example, in your home country, we've created a company called Damana, the Damana Guarantee Company. It's modeled after InfraCredit in Nigeria. And these are local credit enhancement companies that actually mobilize local pension money, long-term local currency funding for infrastructure projects. The idea is to replicate this, in select markets across Africa.
Domestic finance and mobilization. So TDB has played a key role in financing large-scale infrastructure across Africa. So how is the bank evolving its strategy to better catalyze domestic finance mobilization for sustainable homegrown projects?
We've always looked to use local currency where possible. So we have had quite a bit of success in issuing local currency bonds in some of our countries. Of course, it's always limited by the capacity of the particular capital market. So we've issued in Tanzania, we've issued in Kenya, we've issued in Uganda, we've issued in the Seychelles. So we've seen how the capital markets are increasingly open, but of course, the capacity of the capital markets is not able to go very long at this stage. So they're not able to go to the full tenor extent that typically infrastructure requires. So there is capacity, there is scope, but it's going to be building up over time.
Indeed, and we're also seeing an increased focus on leveraging financial markets for growth. So what role does TDB, envision in strengthening local capital markets? You've mentioned capital markets quite a lot. So, in terms of, complementing traditional development finance, and also maybe you can tie this with some of the global shocks that we are seeing impacting the capital markets development.
Well, we've always been very much a partnership-orientated MDB, like many MDBs actually are. So we always look to complement domestic financial institutions. So it's always been that kind of posture we've had. Capital markets, we've not only sought to issue local currency bonds, but we've also, in some cases, invested in exchanges themselves. And so we've stimulated those institutions, we've given them a little bit of risk capital and helped them take off in one or two cases. And so we've done that successfully, and of course just getting more issuances to trade on the exchanges. That's been an important part of the agenda, and we've managed to encourage some of our own clients to issue and to raise debt through capital markets. But again, it's still early stages, so we're not. I think South Africa is in a completely different space. South Africa's exchange is quite deep and wide, and it's got a lot of capacity. I think the rest of the continent is work in progress. South Africa's is also still, to some extent, work in progress, but it's a good story, that one.
In terms of the global uncertainties we are seeing here, the monetary policies, quite a lot that is happening, impacting capital markets. So how do we, mitigate some of the risks associated, when it comes to de-risking investments here?
Well, at least monetary policy has cooled down a bit. It had really heated up in the aftermath of the huge inflation shocks that reverberated across the world. It started in the dollar zone, but many local currency zones also had high inflation, much higher than the dollar zone. And that resulted in very high interest rates. And fortunately, the worst is behind us for now. And so it looks like rates have abated. There's a lot less pressure on that particular front. We will see how some of the new trade policy shocks reverberate into the monetary policy space. It's still too soon to say. There's some projections that it might cause a little bit of inflation, but I think it's too soon to say.
That's it on this special Focus On at the Djibouti Forum 2025. I have been your host, Tabitha Muthoni.